This is video 5 of SciCat Limited, combining debentures in IFRS 9 with IAS 8. We have already looked at what was done. We have looked at what should have been done. We're busy looking at the differences between what was done and what should have been done. The first difference we had a look at is the effect on the statement of profit and loss for the 2012 reporting period. The other item that was affected by the journal entries for 2012 was the investment itself, the financial instrument, the financial asset. So with a item at amortized cost, a financial asset or even a financial liability, you can have a current as well as non-current portion. So when you have a look at the difference between what was done and what should have been done, and there's a difference in the balance, you need to split that difference between current and non-current. So the total balance at the end of 2012, you will find, if you look at all the journal entries, that what was done. All the journals that affect investment, take them into account. What was done, what balance did that give you? You do the exact same. You look at the journal entries of what should have been done to see what should have been the balance at the end of 2012. But that is the total balance. Now you need to split that balance between current and non-current. Now, because this debenture matures in 3 equal annual installments, the amount that is included in here in this balance, part of that will be redeemed within the next 12 months. That needs to be under current. So if we looked at the narrative information of what was done, they told you that the amount that will be repaid within the next 12 months, that is what they put under current assets. So in this case, what they took to current assets, what was done, is a third of your nominal value that matures. That is what was done. What should have been done? Well, what is your rule? Look at the balance at the moment, at the end of 2012. What is included in that balance that will be redeemed within the next 12 months? And the answer is, again, the maturity payment, the nominal value that is redeemed within the next 12 months, the redemption that takes place within the next 12 months. So there's actually no difference between what was done and what should have been done if we have a look at the current asset. Both of them take into account what is included in the balance that will be redeemed within the next 12 months. What is that redemption payment that will happen in the next 12 months? If we, however, look at the non-current part, because our balance, total balance, is different between what was done and what should have been done, even if we take out the same portion for current, what remains under non-current is different because we start with a different total balance. So there's actually a decrease in the non-current balance, a decrease because the total balance is different. So we take out the current portion, which is exactly the same between what was done and what should have been done. What we would present as current is the same. But we started with different total balances. Therefore, the non-current balances will be different. We now do the same for the 2013 reporting period. We first go and have a look at the journals of what was done. Which items are affected? Well, we have investment, again investment, and the investment has a balance. What else was there? The finance income. That is what was done. The bank should not be an issue between what was done and what should have been done. Then we look at the journals of what should have been done. For the 2013 reporting period, what items do we have? Investment, and we can calculate the balance. And we also have the finance income. 2014 is the year we are busy with. So even though we can go to what was done and see what items are there, investment, and what else is there? The finance income. And what else is there? A loss on redemption. We can go and compare that to what should have been done to see what items they have there. But if there are differences between what was done and what should have been done, for 2014, which is our current year, we would just fix it in the current year. You are still busy with that year. You can look at the differences. You can look at what should have been done. You can look at how to change the amounts, but you will do it immediately in this year because this is still the year you are busy with. You can change it while you are busy with that. So it works differently than the 2012 and the 2013 reporting period because they are prior periods that have already happened. You can't just fix them while you are busy with them. They have been in the past. So in 2014, any difference between what was done, what should have been done, do a journal in the current year, fix it. You do not need to tell your users that while you are busy with the current year, you made a mistake, you saw it, you fixed it. That is not something you need to disclose. What you do need to disclose is a note about the prior period errors, about the changes in 2012 and in 2013, not the changes for the current year of 2014. So if you do a prior period error note, the first thing you need to do is you need to give a narrative paragraph saying what was done and the fact that you could go back retrospectively, that you could change it, or if you can't go back right to the beginning of this specific item, you can say how far back could you go retrospectively. So the first thing is narrative, then we start with the different columns. The columns you will see in a prior period error note will be the opening balance of your comparative year, then your comparative year, and what you will not see is the current year, in this case 2014. In a prior period error note, you are never allowed to show the current year. Prior period is about financial statements of prior periods that were already issued, that your users of your financial statements have already seen, and now you realize that there was a mistake in those prior periods. That is what a prior period error note is about.